Guys, I'll be sharing with you one of the trading system that I actually use that have generated a lot of money from the stock market and has been proven to work for me and have generated over six figures. So my trading model is actually incredibly simple. I try to make it as simple as possible for everyone to understand because I believe that simplicity actually equals to profitability, and also a repeatable system is a simple system. So that's what I believe. And before we actually dive into my strategy, I just want to share with you one of the screenshots that I've took from my Tradzilla, which is a trading journal that I've used. As you can see here, from the 1st of June to the 1st of October, so this is a 4 months real result. So I've generated over $300,000 with a 67% win rate and a profit factor of 1.8. What a profit factor actually means is your total wins divided by your total losses. So anything above 1 is a very positive and profitable system. I have a day win percentage of 69. And I show you this is to let you know that this trading strategy actually works. And I've put real money, I've risked real dollars to actually prove that this strategy actually works. That's why I'm sharing it with you for free. And another thing I just want to talk about briefly is also, the reason I'm sharing this video for free is also because back in the days when I first started out trading, I used to hop from one strategy to another strategy to another. I subscribed to a lot of different courses, trading courses. I've paid for a lot of Discord membership to just to learn the holy grail of trading strategy. I want the perfect win rate. I want a win rate of 90%. I want a profit factor of, I don't know, like 100 or whatever it is. So I want a perfect system. And honestly, I realized that all trading strategy actually works. What doesn't work is actually hopping from one strategy to another strategy. And you just have to stick to one strategy that clicks with your trading style, and then master that specific strategy. Then you will make a lot of money from the markets instead of hopping from one another. So this is not a financial advice. This is I'm just sharing with you my journey, things that work for me, and I want to share it to you for free, in hopes for the up and coming traders that you can access to free information like this and not having to pay for it. So let's dive in with my trading model. So my trading model is actually I'm a swing trader. So that's why I put a swing trading right here. And just want to briefly explain to these different trading models. So there are many different trading styles, and my specific trading strategy is actually a swing trading strategy. So if you're looking for a day trade or position trade, you can just click right off, because I'm only going to be sharing about swing trading. And I believe that swing trading is actually the best trading method for me. So what a day trade essentially means is that you enter and exit a position on the same day. A swing trade is where you enter a trade and then you wait for 7 to 14 days for the trade to play out. That's what a swing trading means. And a position trade is 1 to 3 months. You hold a position. And for long-term trade is that you actually believe the fundamentals of a company that is really strong, and then you put money to invest in it in hopes that the price will actually go up and you make a lot of money. So these four methods are actually very different, and all of it works. But I think that swing trading is the best method, is because purely because it's less stressful, because you don't have to be right on the dot at 9:30 Eastern Standard Time. When the market opens, you have to sit on your in front of your computer and start trading at the exact 9:30 dot. Swing trading is more flexible because you don't have to you have to wait for all the conferences to play out in order to enter a trade, and it's not so time consuming as compared to day trade. That's why I find swing trading to be very comfortable, and it's more sustainable in the long run, because we have like our families and friends that we want to spend time with and whatnot. And I think swing trading offers you the flexibility to do that as compared to a day trade. And I think a position and long-term investment do offer that as well, but I find them to be a little bit too passive for my taste. I like something that to be slightly more active than a position trade, because I like to watch the market every day. And the thing about swing trading is also, you don't have to you can watch the market every day. I do watch the market every day, but I don't participate in every single day. It means I don't enter a trade every day in the markets. So that is, with that given fact, it is easier for beginners to balance between work and trading, because I believe a lot of you that are watching the video are not a full-time trader. You actually have a day job that you're working and you try to make money on the side with trading. So I think that swing trading gives you this sort of balance where it's less stressful. That's why I think it's the best strategy that works for me. So what strategy do I use? Very plain and simple. I use the momentum breakout strategy. It's not a strategy that I've invented. There are a lot of momentum breakout strategy on YouTube, on a lot of different places. I'm not saying that I invented this model, but I've refined this model to according to my own conviction, and it works very, very well for me. So I'm just sharing with you what works for me, and I believe that if this strategy resonate well with you, it will make you a lot of money as well. So what a momentum breakout model is, before we go into the strategy, let me just go through briefly between smart money and dumb money. These two are the terminology that is widely used in the trading scene. So smart money essentially refers to institutions, so hedge funds, VCs, things like that. So dumb money refers to us because we are the retail traders. So we always want to follow institutional buying. Why? And the main reason is that because institutions are the only big boys that have the capacities to push prices up or down, of course. And what we want to do is that we want to ride the waves with them and capture the big move. And let me just share with you one of the examples that happened really, really recently, which is August. So it's very relevant. This thing is 2 months old. So United Health in the beginning of 2025 has been declining sharply due to allegations of financial fraud and whatnot. But it has been dropping ever since the allegations, and there's no sense of rebound. I think it has been dropping since like 500-ish, and it has been dropping to the lows of 200s. So what essentially happened is that the stock, Warren Buffett announces that he is buying the stock on the 1st of August, and the stock went up by 33% in 14 days. So 237 to 313. I think now it's like in the highs of like 360 or something. So this is the power of institutional buying, is that they can actually push, they have this amount of money, hundreds of billions of dollars, trillions of dollars to push the prices up. So what we want to do as traders is that we want to follow the institutional buying, because they can drive up the volatility of the stock, and that's what we love. We love the momentum. We want to trade along with the momentum. That's what we want to do. So first, what do I look for? So you have to understand our trading system is that we always want to identify an uptrend or a downtrend. So what an uptrend actually means is when a stock is forming higher highs and higher lows. So higher highs and higher lows. So if you can see here, so this is the low. So this is a high. This is a higher low because this low is actually higher than this low over here. So this is what we call a higher low. And then it forms another higher high because this high is actually higher than this high. So it's a very, you can literally, visually confirm whether it's an uptrend or downtrend just by visually looking at it. So this is what we call a downtrend. A downtrend is where, there is a high, a low. So there's a lower high because this high is actually lower than this high, and then there is a lower low. So with lower highs and lower lows, we can know that a trend is, it's in a downtrend, and vice versa. This is actually in an uptrend. So this is a real case example. Of course, it's not going to be a line. I'm using the candlestick chart. So you can see this is a very clear uptrend. There's a high, there's a low, and there is a high because this high is actually higher than this high. And there's a lower low because this low is actually lower than this low. So this is a very clear uptrend. And I want one concept I want to instill to all of you is that we do not need to capture the whole move to be profitable. We don't need to buy it here and then sell it all the way up here. We don't need to do that because, honestly, guys, we are not, we are not gods. We cannot predict the price when it's gonna top or when the price is gonna bottom. You don't know. So what we want to do is that we just want to capture a small part of this move over here. We just want to capture a small part either from here to here or from here to here. whatever it is. I'll share with you how do we actually, what is our entry model, what is our exit model, our stop loss and take profit model. So we do not need to capture the whole move. Just a small part of it can make us a lot of money, a lot of money. And my trading system is exactly like this as well. So now we get to the juicy part where we're going to talk about the strategy. So the swing trading strategy, high volume, high momentum breakout strategy, essentially consists of 5 rules. These 5 rules over here. This is my swing trading playbook. So we're going to look at these 5 things. So what a short term, we want to look, because we are a momentum breakout trader, we want to identify stocks that have high momentum. That's why we have to identify the short term momentum. We also want to know the relative volume. So the volume essentially refers to the transaction of the stocks. What is how much or how many transactions have been conducted for that stock. We also want to look at the price action, which means what is the candlestick characteristic. That's what called reading price action. And then the structural base. Structural base is the base that we form in the downtrend line. I'll show you an example after this so you can have a better understanding. And then relative strength. So let's say we enter a stock, right? We enter a stock, let's say it's whatever it is, like let's say Grab. We enter Grab, right? Grab is listed in the US. So let's say we enter a stock for Grab. We want to know the relative strength of Grab as compared to the S&P 500, which is, we call it the market. So it must be, if you want to look for buys, the relative strength of Grab has to be stronger than the market. Okay, so down here is the five description of the rules. But before we go there, let me just draw you how we actually trade. All right. So what we do, let's say in an uptrend, there's a high, there's a low, there's a higher high, there's a higher low, there's a higher high, there's a higher low. So what we want to do, right? We want to capture moves at this specific place, so we can able to ride from here all the way up here to take profit. So that's what we want to move. That's what we want to do. We want to capture the move of one wave, or we call it one leg up. So how do we actually do this? So what we actually do is that for short-term momentum, see, I'm just going to go through right here. So for short-term momentum, the stock must be above the SMA 200 and the stock must be above the EMA 20. So the EMA 20 and SMA 200, the definition is right here. So in simpler terms, SMA 200 is the simple moving average 200 days, which also means the average 200 days price of the stock. And exponential is the exponential moving average, the average 20-day price, essentially. The numerical here refers to the days. So exponential moving averages put more emphasis on nearer dates, whereas the simple moving averages have the equal weightage for the 200 days. And we only trade on the 1 hour time frame. Okay, so what that means is that I'll show you the TradingView example, because I use TradingView to chart all my trades. So there is this indicator. It's called the EMA 20. Let's say the EMA 20 is right here. So EMA 20 is a line. So this is where the average 20-day price is. This is what we call the EMA 20. EMA 20. So this is, we want the stock, this stock right here, the price of the stock to be above the EMA 20. And this is when we call short-term momentum. There's a short-term momentum strength. And then from here, what we want to do is that we want to draw a downtrend line. So let me use another color so it's clearer for you. So we want to draw a downtrend line here. Then once the stock break the downtrend line, we will this is our entry model. We will enter right here, and then we will put a stop loss right here, and then we tend to take profit up here. So this is just the overview of the trading strategy. It's very, very simple. We just need to draw a trend line. So what the relative volume actually means is, upon the breakout of the stock right here, what is the volume looks like? That's what the relative volume means. So we want to compare the breakout of the candle, breakout of the trend line. We're going to compare that specific breakout candle's volume compared to the average 50 days volume. So all these can be, input from the indicator. You don't have to do this all by yourself. You can use TradingView. Everything is automated. I can show you a real life example, but just bear with me, guys. Just follow through the strategy. So the price action of the breakout has to be strong, which means the candlestick here that breaks your trend line has to be strong, and the structural base refers to the how many days has been consolidating below this trend line, below this downtrend line that you just drew. And the relative strength is just a visual confirmation to see whether this specific stock that you're trading is stronger or weaker than SPX, which is the market, is the S&P 500. So for all the trades that I've taken, right, I've used these 5 confluences to decide whether it's a good trade or a bad trade. So I know this is a bit confusing, but let me just give you a few examples. So let me just drag this down here, so I can refer it to, so you can see. So this is a real life example that I've traded. It's on the 15th of September. Some of you have seen this on my Instagram. So this stock is Intel. I think a lot of you are very, very familiar with Intel. So as you can see, I entered this trade live as well. I just want to share with you how do I enter Intel. So you see, this is a stock price, right? And this indicator right here, this red line is actually the EMA 20. You can see right here, there's EMA, it's an EMA 20. So the stock went above EMA 20 around August, the 12th of August. It went above the EMA 20. So we know that this stock is actually on an uptrend. It's a very short-term momentum is strong. So it's forming a consolidation, so to speak. So what we want to do is that we want to draw a downtrend line. So the downtrend line we drew from this price covering to this price. We haven't seen this candle happen. So how do we actually draw a trend line is that we want to cover as much of the candles as possible. Of course, we can connect it from here all the way to here or here. It doesn't matter, but we want the slope of the trend line to be less steep as possible, and the best way to draw it is from here. So this is a bit discretionary. Of course, you can draw from here to here. It will actually changes slightly in terms of your entry and stop loss, but the rest of it works as well. You can draw from here to here, so you can draw one straight line over here. Okay, so the structural base means that how many days that the price have been moving under this trend line that you drew. So in this case, it's 20 days, which is fairly good, because we want the base, we call this the structural base, to be at least 10 days. So the relative volume of this stock, you see, there is a very obvious breakout. So you can see this is the volume profile. So the volume shows that there is 2.5 million transactions, which is, you can see it right here as well, 2.54 million. Then this blue value actually refers to the average 50 days volume. So you see this blue line over here. This is the average 50 days volume. So average 50 days volume is actually 500K. So if you take 2.5 million divided by 500K, it's actually 5. What it means is that at this breakout, there's 5 times more than the average volume, which means there's a lot of transactions. There's 5 times more than the average 50 days volume. So we know that this breakout there must be something happening at this breakout. That's why the relative volume is really, really good, because we want the relative volume to be above 2. And then what else? The relative strength. So the relative strength refers to another indicator is the Trader Alliance relative strength indicator. So it automatically plots the S&P 500's average price. So if the stock is for the past 10 days, or 10 to 20 days, if the stock shows, the indicator shows you the blue line, refers that it implies that the stock is actually stronger than the index. Whereas if it's a pink color dotted area, it refers that the stock is actually weaker than the index. So It's very obvious that Intel has been, consolidating. Is pretty much the same. It's pretty much weaker than the index, right until the August 12th, which coincides because when it crosses up to the EMA 20, which shows strong short-term momentum, the relative strength shows you that the relative strength is fairly strong as well. So that's why the RS is considered strong in this case. So these 5 confluences is to explain to you how we actually mark out our entry model and our exit model, which I will show you in later part of the video. But it's very, very simple. All these are very quantifiable. The price action here refers to the breakout. So as you can see, there is 75% body and 25% wick. This is what we considered a strong momentum candle. Candles like this, where there's minimal wick. Wick is the line above or below the body. If there's no wick involved, it's a super strong momentum candle. It means the price action is good. We know that this is not a fake out. So this is to explain to you alongside with the visuals so you can better understand. And you can kind of have a screenshot over here of what are the specific rules in terms of the numbers. I'm not going to go through each of them. I'm just going to go through the examples. If you have a look right here, what actually happens after we enter our stock? So remember, we enter right here, right? So we manage to take profit the next few days, right around $32. So we risk around 1.25K and the reward is 9K. So it's a 7.5 risk to reward trade, which is extremely good because our initial target was actually 2. We wanted to risk 1.2K in return of 2.5K. So that's our initial target. So you can see these examples that I'm giving is actually a real trade that I've taken. And this is also the screenshot from TradeZilla. The trade risk is 1.265 thousand. Then in return the net P&L is 9.5K. So this is to show you that this trading strategy actually works. And I've taken these trades with this strategy. I'm just explaining to you the thought process of how do I enter. So with that being said, I'm going to give you another example. So this is something that is earlier. This is the 2nd of September. So 2nd of September, we enter another trade. It's called Lyft. Lyft, it's a US company, if I'm not mistaken. So again, we want to go through with these 5 rules that we have over here. So let's dissect it, all right? So the stock went above the EMA 20 for more than 3 days. So it went up here. So it starts to form a higher high, higher low, higher high, higher low. So we drew a trend line right here that covers roughly 8 days worth of candles. So notice that this is a 1 hour time frame chart. So it covers 8 days of this candles. So we drew a line, and then the next day when the market opens, we saw a breakout. So this breakout candle is really, really nice because there's literally no wick. It's all body. So there's 100% body and 0% wick. So we know that the price action is good. So tick. This thing it's good. We know that this is good. Okay. So the stock is above the EMA 20. It shows that the short-term momentum is strong. So this is good. So right now we want to talk about the relative volume. So we only refer to the volume. This is the volume table. We only refer to the volume table at the breakout candle. So this is the breakout candle. We can see this volume over here. We know that the breakout volume is 391,000, as you can see here as well, 391,000. And then the blue line refers to the average 50 days volume, which is 186. You can see right here as well. So this one refers to the blue line. I always read the volume from the top left corner over here. But your cursor has to be at this specific breakout candle. So we know that if you take 391, which is the breakout candle, divide by the average volume, we know that the RVOL, which is the relative volume, is 2.1. So anything above 2 is a good relative volume. So the relative volume is a pass. So we have 3 pass. Structural base, a minimum of 10 days is required. So we know that this is not ideal. So this is a fail. And let's look at the relative strength. So relative strength, I use this indicator, Trader's Lion indicator. You can input this from your trading view. It shows me that the stock for the this is a day graph. So for the past, I would say 10 days or so, the stock has been stronger because it shows a blue area instead of a pink. So we know that the stock is stronger than the index. So we only want to trade stock. We only want to buy stocks that are stronger than the index, and we only want to sell stocks that are weaker than the index, because index is the reference point that we are using right now. So we know that it's a blue gradient, gradient area, whatever it is. It's a blue one. So we know the relative strength is good. So this is a pass. So we have, out of the 5 different rules, 3 of them is a pass, 4 of them is a pass, and 1 of them is a fail. So I don't actually have a hard pass or fail. What I do is that I give a weightage across the 5 different strategies. I'm not strategies, 5 different rules. And then based on the grading system, they will tell me whether it's to enter a trade or not. I'll share with you these in later detail, but you can have a look. So we entered this stock, apparently. So I entered this stock at, let's see. Yeah, we entered this stock right here. It's very obvious. So then again, I'm just going to go through again, bear with me. So there, the stock went above EMA 20. It forms a higher high, higher low, higher high, higher low. And so we drew a trend line over here. There is a strong momentum candle. The volume is great. So we enter our stock right here. So this red box you are seeing is the risk that we took, and the green box is actually the target profit that we want to hit. So you can see that the green box is always 2 times bigger than the red box, because our profit target is always 2 right here. So we are risking $2,500 and we are targeting at least 5,000. So the profit, I think it hit exactly the next day or so. This is the next day. So this entire trade took us 1 week to realize the profits. And this is also one of the trade that I took and closed out on the 3rd of September. So you can see we risked 2.5K and we made 5K from this trade. So we're always targeting at least 2 times the risk. So if you're risking 1K, we're targeting 2K of profit. If you're risking $10,000, you need to get at least $20,000 of profit. So we call it 1 to 2 risk to reward. So that's our minimum risk to reward that we're trying to get. So these 2 examples are the real examples that I've took the last month, because I want to share something really, really recent so you guys can actually relate to. So I think you guys understand the 5 different rules and how do I use it to for my entry and take profit. So in terms of entry and how do I place my stop loss, I'm going to share with you how do I place my stop loss. So this is my entry and exit model. I'm just going to give you a very clear, this is the trade lift, the same stock that we just talked about. All right. So the market opens at 9:30 every single day. Not every single day, like Monday to Friday. If you are living in Malaysia, it opens at 9:30 p.m. If you're living in the States, of course, it depends on which area you stayed in, but it's 9:30 Eastern Standard Time. So my entry is always 1 hour, almost an hour after the market has opened. So I only trade during 10:20 to 10:30, which is 1 hour after the market has opened, because I want to wait the first hour candle to fully form. So let's say today, let's say this one is on Monday. So this is the first candle on Tuesday. So I need to wait until this candle is fully formed before I can actually enter or exit a trade. So assuming I draw a trend line right here, right? So how I actually calculate my stop loss is I use the average true range. This is also an indicator you can find on TradingView. It's called average true range. Just type it in the indicator section. You can find this. So what I do is that average true range, what it means is that how much a stock can actually move in one single day. So let's say this is the market is right here at 10:30. So what I do is that at the intersection point of the candle and my downtrend line, which is around here, this is the intersection point. So I take these specific price, let's say it's $5, let's say it's $5, and the average true range, the ATR, which is the maximum price you can move in a single day, let's say is it's let's say it's 80 cents. I'll show you a live example, don't worry. So 80 cents. So what I do is simply take $5 and subtract it by 80 cents. That's $4.2. So $4.2 is my stop loss. So what it means is that if the price went below $4.2, I will exit this position as a loss. That's what it means. So if I'm risking 80 cents, I need at least 2 times of that as profit, which also means it's $1.60. So that gives me $6.60 as my take profit target, because I always want to make 2 times of what I risked. So this is the basic stop loss and take profit model that I've been using. So exactly this stock you guys can see. Okay, use this example. So the ATR, you can see the ATR is right here, right? It's down right here. So it's 42 cents. Lift is $16.50 at the entry. So you want to know where's the stop loss. And this specific price, the intersection point is $16.22. The ATR is 42 cents. So the stop loss is simply taking this intersection point and deduct the wait, sorry, I lost my train of thoughts. Taking the intersection point, deduct the ATR, and you get 15.8, which is exactly this red box. As you can see, the target profit is always 2 times. The size of this green box is always 2 times of the red box. So we want the stock to hit at least $17.87. So we will make twice of whatever we risked. So this is a very simple concept. And to give you a real life example, these are the 2 of the trades that I've taken this week, which is currently, as you can see, today is the 6th. No, sorry. Today is the market closes on Friday. So this is 3rd of October, which is yesterday. So I've taken this trade on Wednesday, which is 3 days ago, 2 days ago, 3 days ago. And let's just go through the confluences. So the stock went above the EMA 20. You can see this is the EMA 20, the red line. So the stock went above the EMA 20. So it forms a high, a low, a higher high, higher low, and it didn't form a higher high yet. So we drew a trend line. This is the least steep downtrend line that I can draw. So I cover all the wick from here to here. So upon market opens, you can see down here 9:30, right? Here 9:30. Upon market opens, there's a huge momentum candle that broke out of the what do you call it? The trend line. So we can see the relative volume is huge. If I put my cursor right here, you look at the top left, the volume is 3.2 million. The volume is 3.2 million, and the average volume is only 500K. So there's a 6 times relative volume. So the volume is good. Downtrend line is good. Price action is great as well, because the body is almost a fully formed body. There's minimal wicks. And also the base structure. Let me see the base structure. How many days it is? It's a 7 days base structure. So this is not an ideal base structure. But if you go to the relative strength, I just open this up and I go to the day chart to have a look at the relative strength. You can see the relative strength is insanely huge. So what it means is that it's way stronger than the market, the S&P 500, the SPX is way stronger. So if SPX tends to move up in the market, this stock will definitely fly. Is what it means. So my thing is really simple. I enter up around this area, as you can see. Let me just adjust this. I enter the stock at this price, which is 14.52 cents. And then I take the intersection point, which is, 13.48, and minus the ATR. You can see at the bottom left corner over here. So which is around 97 cents. So I take this 13.4 minus by 0.76. It gives me around 12.72. And you can see this table here, the risk reward is 2.15, which means if I risk $5,000 and the stock hits this green box over here, I'm going to make $10,000. So it's very, very simple. So you guys can go through and have a look at these stock. This is what I've been using. Entered here. These are the ongoing long trades. RVMD, I almost hit TP right here. It went down a little bit, but it's okay. Let's see what happens on Monday. It's the same thing. The stock is always above the EMA 20, which means the short-term momentum is strong. We drew a downtrend line right here. The stock broke out on Monday. So I entered on Monday. See the fully formed right here. I entered on Monday. And the base, it's roughly, let's say, 13 days, which is amazing. So the short-term momentum is good. Price action, the breakout candle is good. Volume it's okay. It's not too bad. It's 16 point. You can see the number right here, all right, at the top left. Let me just point to that price. Sorry, it's this one. Yeah, it's 17K the average, and the breakout volume is 36K. So it's almost like 2 times, which is good. Now the last confluence we have is actually the relative strength. Okay, have a look. So relative strength has been good for many weeks already. It's always at the blue area. So we know that this stock is relatively stronger than the market. So with that being said, this stock is a good trade. To calculate stop loss is fairly simple. It's the same thing. Intersection point minus the ATR, you get the stop loss number, and then your take profit is always 1 to 2, at least. So you can see 1.99. So I'm risking around $5,000 for this trade. If it hits, I'm going to make $10,000. It's plain and simple. Same thing with IOQ. I'm just going to go through really quickly. Stock is above EMA 20 for many days. For more than 3 days. More than 3 days is considered valid. So as you can see, higher high, higher low. So we drew a trend line, and it broke out on Thursday, which is like 2 days ago. So the momentum, you can see the volume. The momentum candle is good because there is minimal wick. It's all body. And if you look at the volume on the left, the average volume is around 450K. And the breakout is around 1.2, which is 3 times. Three times the relative volume, which is a great volume. So the base structure is roughly 7 days. It's not ideal, manageable. Now let's go to the relative strength really quickly. It's freaking strong. So very simple. 5 confluences, 4 hits. 1 is not too shabby. So it's a great trade. Same thing. I don't know whether it's gonna win or lose, but seemingly right now it's in the green. I'm making money. The stop loss is basically this intersection point right here. Deduct by the ATR it gives us here, and then we want to make at least 2. So I entered 4 trades last week, and 3 of them are in the green, and 1 is in the red. So this is CRM. I think I called this out on Instagram. Not my fault, guys. Just letting it probably play. I'm not gonna know whether it's gonna win or lose. But same thing. This is a good example because it's a downtrend. So we can see there's a wait. Let me just zoom out a little bit. So there's a lower low, higher low. Actually, it's not a lower low, but let me just zoom out a little bit further. Yeah. So as you can see, it's been going below the EMA 20 for many days, since many months actually, since June. So it went a high, a low, a lower high, lower low, lower high, lower low. So we know that it's in a downtrend, and the stock is moving below the EMA 20. So what we're trying to do is that we try to short the stock. So we drew an uptrend line. So once the stock broke out of this this uptrend line, with very high volume, as you can see, same thing. 82K is the average. 80K is the average volume. The breakout volume is actually 250K. So there's a 3 times relative volume, which is huge. Then again, the candle has minimal wick. The body is very, very strong. So we know that this is a momentum candle. It's a good confluence. And the base structure is actually 26 days, which is very good. So all those 4 confluences passed. Let's see the last one, which is the relative strength. So if you remember correctly, I said that if the area is pink, it means that the stock is weaker than the market. And if the area is blue, it's stronger than the market. So a very obvious CRM, Salesforce, is actually weaker than the market. So if you want to short a stock if it's weaker than the market, if you want to long a stock if it's stronger than the market, that's what we're trying to do. So out of the 5 rules, it passes all 5. So again, we shot this trade on 30th of September. It's been how many days? It's been 3 days. We are in the red right now. We are losing money, but we haven't closed it out because he hasn't hit our stop loss. For stop loss, for short trades are the same thing. You take this intersection point, instead of subtraction, you plus the ATR. So the stop loss is going to be here, and the take profit is going to be same thing, 2 times. So I know it's, I want to record this as a video so you guys can go back and understand the confluences. Remember, if you want to know the exact number of the confluence of the rules, you can refer to this right here. So I'm not going to go through right now because I think you have a clearer picture of what is actually happening. So the stock must be above the EMA 20 for at least 3 days. So the relative volume has to be ideally above 2. So you take the breakout volume divided by the average 50 days volume. So the price action ideally has 0 wick, but normally what I do is that I can accept the body to be 75%. So it means that this is the body, this is 100% body. So if there is minimal wick like this, I'll still consider it as a good price action breakout. So the structure base refers to the how many candles are below the downtrend line. How many candles are below the downtrend line, or for a long trade, and how many candles are above the uptrend line if you are looking to short. It, right? To long it. So ideally, you have to have 15 days or 20 days worth of candles. This is the longer the consolidation below the downtrend line that you drew, the better. So the relative strength is very simple. You want to have a lot of blue area for long trades, and you want to have a lot of pink relative strength for short trade. So all these indicators that I've just talked about, all these indicators, you can just go to your trading view. You can go to your trading view here, and then you click this indicator box up here, and then you start to type in, see trader line relative strength, which is the relative strength line. You can type in EMA. So you have the EMA line, just click, and then you have it. And if you want to know the volume, just click in volume. Just volume, this thing over here, then it gives you everything that I've just talked about. So I hope that it's simple enough for you to understand. I always try to break things down as simple as possible, and this specific strategy works because I've tested. But I don't want you to take my word for it. I want you to back test your strategy. I want you to back test or trade with demo money, so you don't have to risk your real capital. Until you have collected enough data to prove that you are profitable, then you start trading with real money, but with very, very small capital, because you will start to build confidence, start to build your real conviction, and then hopefully you will start making money, 6 months, a year from now, or next week. It's not gonna happen, guys. You need time. All right, guys. With that being said, I appreciate if you give me a like, a subscribe, so I can know. I can start posting more about these kind of videos. If you guys enjoy it, just let me know down the comment section below. Cheers, guys. See you in the next one.